Good day. My name is Christos Theophilou from Taxand Cyprus, and I welcome you to our webinar, Transfer Pricing for Funds, Is it an Art or a Science? In this webinar, we will be presenting to you how to manage your transfer pricing risk regarding the fund industry, and this is the way that we will do it today. Next slide, please. Now, in this webinar brought to you by Taxand, we are very excited to share our latest practical insights on the tax and transfer pricing for the investment funds management industry, discussing the shifting of business model, the tax risk to avert, and all the essentials that you need to know to secure your high standard compliance and also navigate complexity. We are bringing together the viewpoints of our international panel from Taxand Cyprus, Luxembourg, the UK, and the US, and we are also pleased to provide a different perspective as well from the fund management industry. Our guest speaker, Niall, from First Sentier Investors, which is a leading provider specialist on investment capabilities. Now, before we kick off, I would like to mention a little bit of our practicalities. We'd love to hear from you, so please do submit any questions that you may have on our Q&A box. You will see it on your screen, and we are going to address all your questions after the presentations and the panel discussion. Of course, we are going to have poll questions as well, so feel free to answer the questions, and we are going to analyze the results during our panel discussion. For sure, our presentations will be circulated to all attendees after the event, and you will find there our speaker profiles in case you would like to contact us. So, before I begin with, let me welcome those that they just joined. Welcome to our webinar on transfer pricing for funds. Is it an art or a science? And without any delays, let me kick off this webinar. Next slide, please. Now, this is a typical structure for our alternative investment funds, and we all know that within the fund environment, all the intra-group transactions should be priced at arm's length, and ideally, this should be not in isolation. So therefore, the supply chain management is crucial, and my colleague Fabrizio from Taxand US, which is Alvarez and Marshall, will shed more light on this highly important topic. Next slide, please. Now, the other two important transfer pricing issues that we have in the funds industry is that the first one is the intra-group management fees that are shown on the diagram on your left-hand side. Now, such management fees shown in yellow are typically between the fund management company and the service provider and or the investment advisor, and such management fees, they should price accordingly. My colleagues, Andreas from Taxand Luxembourg, ATOZ, and Gaspar from Taxand Cyprus will provide you their practical insights. And moving on to the second important intragroup transaction, it will be the right-hand side of the diagram, which will be the intragroup loans. And my colleague Deyan from Taxand UK, that is Alvarez and Marshall, will provide you his viewpoint and practical issues on debt pricing. Next slide, please. Now, for completeness purposes, let me briefly outline the tax implications of how to set up a fund. Now, under the first step, the investors need to inject the money in the fund, and such fund will either take the form of a company, will be a tax subject and a taxable company, or if you want to avoid any economic double taxation, you can set up your fund as a fiscally transparent vehicle, such as a partnership. Then the fund will invest its funds accordingly. Now, importantly, under the third step, it is important to get allowable deductions of all outbound payments from the investment state, usually called the source state, for all payments made. Typically, such payments will be interest. And not only getting a deduction on such interest, you also need to take into consideration whether there will be any restriction on such excessive interest. And excessive interest this is something that Deyan will be discussing about debt pricing later on. Another issue that we need to consider under the step 3, of course, is that the fund management needs to effectively pick up a favorable tax treaty, that the tax treaty will reduce the withholding taxes paid from the investment state jurisdiction to the fund, and such outgoing payments are typically, from our experience, dividends and interest. Now, moving on to step 4, which is at the fund level. As we mentioned before, if the choice is to set up a fiscally transparent vehicle, then there is no tax implications. If the choice is to set up a fund like a company, which is a tax subject, then there you will be looking to set up your fund in a favorable tax regime. Largely, such a regime will have a taxing favorably, I would say, passive income. And such passive income are largely dividends, interest, and capital gains tax on sale of shares. Or you need to look for a special tax regime such as NAV taxation. Now, when the money will be repatriated from the fund state to the investor state, then you need to select a jurisdiction that the fund will be located where there will be no withholding tax on funds distribution. Now, finally, at the investor state, because all the distributions will be taxed on the hands of the investor, you need to look up that state, the jurisdiction of residence of the investor, tax favorably any dividend income, maybe you have any CFC issues, or no or low with capital gains tax on the sale of shares or units. Next slide, please. Now, we will not forget the fund managers. So let me give the typical implications of fund managers. Fund managers need to consider effectively their ordinary income tax implications in the country of residence. Such tax implications you need to look at for any non-domicile regime like the UK or Cyprus, or any tax breaks on inward expats that various jurisdictions include in their domestic legislation. Also, you need to consider the taxation of management fees, performance fees, or carried interest, how this income is taxed. And also, you need to consider transfer pricing issues, which is what we've been discussing today. And another issue that you need to take into consideration, whether the fund manager constitutes a PE in the country of residence or elsewhere. Next slide, please. Now I pass the stage over to my colleagues Gaspar Lopes from Taxand Cyprus and Andreas Medler from ATOZ Tax Advisors in Luxembourg, who will be covering the management fees from the Cyprus and Luxembourg perspective, and also Niall will be providing his comments as well. The stage is yours, guys.
Yep, thank you, Christos. So yeah, indeed, like fund management activities, they have been like more and more in the focus of tax authorities in Luxembourg, but also abroad. That's mostly because like it's not only the amounts which are paid are quite substantial, but there's a lot of like to be gained from a tax raising perspective from the tax authorities' point of view, but also the fact that this is a very highly integrated activity, which is mostly implying a couple of entities situated in a couple of countries. And what makes it particularly intricate is also that sometimes the same function is divided over a couple of entities in different countries. So this is a very specific TP topic which taxpayers should have on their radar, because it's not only a hot topic, but also the amounts at stake are quite significant. And just to visualize, like the chart on the left side that depicts like a typical basic setup for fund management activities. It's really just a basic setup. It varies like from group to group. And what experience shows is also that every setup is unique. Like every group has a different strategy, a different number of entities involved, a different strategy. So this is just like one base case example, which is like to be adapted to every case, like a given case at hand. So the chart on the left just shows a Luxembourg fund and alternative investment fund manager, but it could likewise be like a fund in Cyprus or manager in Cyprus with like the asset managers and the investment advisors, for example, often being resident in the UK, but that's all interchangeable. So what does play a role is not only like the group organization, the country of residence, but also the legal form of the funds used. For example, some funds require a general partner, whereas like some other types of funds are directly managed by a management company. The magnitude of the operations has an impact on the TP analysis. So that makes every TP analysis on fund management fees really like a unique and bespoke piece of work. As you can see on the right side, just to embed the fund management fee topic into a wider context, fund management fees should not be like what the TP side should not be kind of considered on an isolated basis. It should really be considered in the context of all the other relevant topics, which are relevant for the planning, the operational setup of the fund, and the implementation. So just to name a few, as you see on the right side, which also have an impact on the tax efficiency, for example, and the overall setup, the allocation of human resources. You would first need to consider the business model of the company, all the roles and responsibilities of the companies involved, and not only look at the transfer pricing outcome or the desired transfer pricing outcome. One very important topic, especially for jurisdictions like Luxembourg, but something similar would also apply in Cyprus, are the limitations set by the regulatory requirements. Because, for example, in Luxembourg, it is embedded in the law that an alternative investment fund manager cannot be a pure letterbox company. So by law, they are required to fulfill certain substance and regulatory requirements. So they need to have some people on the ground. For example, they cannot delegate at the same time several core functions. So a Luxembourg fund manager can never delegate, for example, the risk management function and the portfolio management function at the same time. Based on experience, you see that portfolio management is more often outsourced. That means like the risk management function is very often the key function performed from Luxembourg. This also ties into like another set of regulatory requirements. A very current hot topic in Luxembourg, for example, that's quite interesting as a side note. The Luxembourg regulator, the CSSF, have started also performing some audits on the internal risk management systems of fund managers in Luxembourg, see how they deal with like compliance monitoring and the recent developments in the anti-money laundering regulation in Luxembourg. So this is all like kind of one big context where TP has to be embedded in. Also, like last comment on the regulatory side, the Luxembourg regulator is typically not really fond of regulated managers being in a loss position. So that's also one point to keep in mind for the allocation and the attribution of profits. Next slide, please. So in summary, I would say like that on this basis, but also considering the number of functions that an AFM as a whole has to perform, the TP analysis really requires a holistic view and goes far beyond the mere text dimension. So it's really considering the entire business model and also looking at this. That's a very strong recommendation before the at an early stage of the process. This is something we will also discuss a bit more in detail in the panel discussion later on, how to address this from a tax risk management point of view. But in terms of like approach, what is very important is that like at the start of each TP analysis, you look at the functions and the responsibilities of the different companies, who's using, for example, valuable intangibles. For example, an asset manager with like a huge track record and a good reputation may be considered to benefit from his reputation being an intangible asset, which also needs to be considered for the transfer pricing analysis. So there's a number of factors to be considered. And in a nutshell, just to touch upon the key issues, I think we have like the key functions that we look at from a fund management context are like fund and portfolio management services. That's typically the service which attracts the most added value. But here we also need to distinguish between the different strategies of a fund. For example, a core plus real estate fund would be a little bit less work intense on an ongoing basis than, for example, a development fund, which requires ongoing and active daily management. So you see that like every single case has its specificities that need to be looked into. Then the risk management function, as I touched upon before, and very important also the marketing and fundraising function, which is so important that we actually want to dedicate a few sections separately on this. And finally, like valuation and fund administration services. So all this to say that there is no one size fits all approach, and that there's really like every TP analysis is individual. And I would like to pass on the word to my colleague Gaspar now, who would like to share his experience on the marketing and fundraising functions.
Thank you, Andreas. So picking up on your last cue about distribution and fundraising, indeed, so we start by talking about the setup of funds and the fund management groups, and the focus is, as the title indicates, on management fees. But aside from that, a lot of funds put a lot of emphasis on distribution and fundraising, and consider those the distribution function to be a key function tied to the success of the fund on equal standing as the portfolio management or risk management functions. And so we could think about, from a transfer pricing perspective, the types of models that we often see in order to have an analytic framework to analyze this and help substantiate the allocation of profits within the group, reflecting the relevance of these different functions for different groups. And definitely, these are things that are driven by business, by the business setup, and by the nature of the funds. So one of the key elements here is timing. Funds that so the whole life cycle of the fund will require different involvement of these functions. So there may be funds for which the distribution in fundraising was an absolutely essential function, but all the activities have been done prior to the launching of the fund. And so if you look at the allocation of profits between the group entities year by year, there has been an essential contribution by the distribution and fundraising activities, but that has all been done prior to the fund being launched or in the first year of activity. And that's often the case for closed-end funds. And so we could think essentially of maybe three models: one in which you would have distribution as being a key function alongside portfolio management, alongside perhaps other key activities, and there you could have models with a central distributor and then a retail, often a wider distribution network. In some cases, there could be a combination of group entities and outsourcing of these activities, or plain outsourcing to a placement agent. And bank and the network of banks, wealth managers, and other agents, and these are often and the types of remuneration that we see on the market for these entities sometimes are very significant, and that indicates the value associated with this activity. In other cases, we'll have entities that are relevant but do not stand at the same level of portfolio management activities, for example, and those would be risk-taking but not having the same stance. And then you would have other cases where fundraising is actually of a minimal contribution, because the investor pool has been set up. That's often the case for a small group of investors, or for funds that have their links to a particular group of investors, and then there may be little contribution there. So these are a few thoughts on the TP framework that can be that is relevant for the distribution function. There's a few other points that we wanted to mention here, and one of them is coming back to the topic of substance. Substance is extremely relevant, and especially maybe for the first case that we have mentioned, which is well represented also in the structure, which by way of which the risk management function and the portfolio management function are separated. That creates the need to evaluate their relative importance, and for those that for cases where perhaps the risk management function is less significant in terms of number of people or in terms of actions on the ground, it's good to have a framework in order to be able to understand how to structure the group, and for taking into account taxation and transfer pricing in particular. And so the OECD transfer pricing guidelines provide a few thoughts on this, a few guidelines on this. One is how to document internal processes in order to make sure that the decision making is aligned and with the intention of the group, and that the control over the risks is exercised in a way that reflects the contracts and reflects the setup of the group. So this would include things like documenting how decisions are taken, how goals are set, budgets, often for outsourcing of smaller functions. We can see also on the slide services. So setting up decisions and checking whether the performance and the outcome matches is relevant. And aside from that, also quantifying things like the working capital or access to funds are also essential in order for the entities to be able to manage their exposure and their exposure to risks and in relation to their transactions within the group. So we have two more points about transfer pricing documentation and MAP procedure, the mutual agreement procedure, and other ways to manage risk in relation to tax. But we'll come back to that during the panel discussion. And so at this point, I'll pass on to my colleague, Deyan, for the debt and SINCAP points.
Hello, everyone. I will speak about debt pricing today, which I presume for most of you is a particularly interesting topic on the basis of the fact that pretty much every or almost every acquisition comes with certain investment under the form of debt, whether it's from a third-party bank or whether it's intercompany. In my practice, from what I have seen, there are pretty much two. We can split the way that funds operate into two stages. So we have stage at the acquisition of the target, then the stage post-acquisition, or some may also call this preparation for disposal. So the drivers for debt pricing work and developing the debt strategy can be slightly different between these two phases, because during the actual acquisition, it's all about the deal, getting the deal done, making sure you put the right amounts of debt, get the policies correct, and that has a particular time frame. Post-acquisition, it's more about maintenance and making sure that everything that has been put at the time of the deal is still valid. So the way that I like to think about transfer pricing is that I actually like to ask questions rather than say whether this or that thing is the right thing. So as part of these two cycles, there are probably 3 questions on each side that I have found very useful in my practice, plus one big question that pretty much covers the whole. So on the acquisition side, there are the 3 main questions are: do we have the right policies in place? So have we done our work correctly in order to define the terms and conditions of loans? Second point is, are we taking into consideration all of the potential options? And I have noticed that sometimes clients like to put flexibility in deals, which flexibility may somewhat go counterintuitive, or may create issues later when you speak to the tax authorities. And the third point is going back to that flexibility, but from a different perspective or from a different aspect of it, which is, can we actually do things in a way that on one side it makes sense from a transfer pricing perspective, authorities perspective, but also it gives us sufficient flexibility for the fund in case we want to achieve some additional non-tax related objectives, such as, for example, cash repatriation. On the post-acquisition, we move into a slightly different dynamics, which is more about, okay, so we have the investment. What sort of things have we done, or what sort of things do we need to do over the life of the investment while we own the asset? So there are, again, 3 questions that I like to ask. First one is the analysis and the documentation, all the paperwork that we have put in place during the acquisition still relevant? And what extent do we know whether that particular acquisition we did in 2018, for example, it's still the same company? Did we buy some, had some bolt-on acquisitions? Did we dispose of a part of the business or the whole? So do we take those considerations, or do we have on one side the paperwork, but also the actual terms up to date as to what has happened in the cycle with the business? Second question is, and this is certainly very, very important, is have we applied the TP policies correctly? So we have an advisor, they have given us the answer, but are we sure that whatever we have in the intercompany agreements is correctly applied to the terms and conditions in the per the advice? And do we, the fund manager, do we understand completely what has been advised and how we have applied it in practice? And the third one, which I think is probably the easiest one to overlook, is do we, as of a particular point in time, there are external and internal factors that are changing. So the first 2 points cover the internal factors. The third one is more about, okay, what is happening in the world that could potentially change some of the policies and that we should take into consideration in order to make sure that we are up to date. One such external factor is, I'm pretty sure you guys know about the LIBOR transition right now. So for any transactions that we have that are based on floating LIBOR plus margin rates, do we know how these are going to convert in the new world after the 1st of January 2022? And then one main topic across that covers both at acquisition and post-acquisition world, which is, do we have proper documentation? And I know people don't necessarily like to speak about documentation that passionately as we advisors like to. But documentation in this case doesn't only cover the actual TP report. It should cover also the intercompany agreements. It should cover any of the board minutes that may or that should in theory be reflective of what the intention was The last and probably the most important question is, do we feel comfortable that we can go for TP audit in case tax authorities knock on the door? So on the basis of that summary, I have one question for you, Niall. On the basis of your, your experience and what you have seen, which areas would you think are probably the most important for the fund where you operate, where you work?
Yeah, thanks, Deyan. And having worked on a number of projects with you, I think you're probably well aware of the important pieces that we think about. But no, for us at FSI, we're an active long-term infrastructure investor. So from a practical perspective, the important thing for us is an assumption that we make and a policy that we take is with us for quite a long time. So in particular, thinking about that, an easily missed area is thinking about the points that Deyan raised there on acquisition. So actually thinking about these transfer pricing items, particularly on debt pricing, particularly on the margin that's left in any holding companies, that forming an important part of the acquisition process rather than being secondary to that acquisition process is something that I've certainly found practically important. And so with that, sort of those frequent interactions, as things change, as we have add-on opportunities, as we look at changes to the financing that we have from external lenders, what interactions do we need with the experts? And that's an area that needs constant interaction, that constant close contact. I think one of the really interesting pieces is thinking about actually what is the role, what are the TP considerations before making an offer for an acquisition, and making sure that across for myself, across the rest of my team, that my deal team colleagues are aware of have a bit of an education on transfer pricing and debt pricing and how that might interact with some of the assumptions that we make. So no, really, really interesting, Dan. But in the interest of time, I'll pass on to Fabrizio from A&M US to talk a little bit about a supply chain in this context as well.
Thanks, Niall. I'm going to be giving you a bit of a helicopter view on value supply chain planning, given the short time frame. So what is it, and why are we talking about value chain planning in the context of interest rates and management fees? Supply chain planning is really a very valuable tool that allows you to optimize the business models of the portfolio companies by centralizing some key functions and risks into sort of one super entity or multiple super entities or hubs. So why is it relevant? So the other speakers already addressed some of the issues in sort of pricing sort of the debts and pushing down management fees. And there is always the desire, obviously, to charge the highest possible interest rate and extract as much management fees. But the reality really is that the financials of the portfolio companies are what drive your ability to charge a higher interest rate, to get the right deductibility, and to charge management fees. So having the ability to optimize the business model and generate create an entity that centralizes profit and also centralizes some of the commercial and tax synergies can create that kind of those financials that you need to support your financing and your management fees. Next slide, please. So when is a good time to start thinking about value chain planning? So it all starts with the acquisition strategy, and it's really important that you start thinking about value chain planning pre-acquisition. This is when you can take a snapshot on what the potential target, what the structure looks like, where the inefficiencies might be, and how you might what options you have available to really change and optimize that structure and then implement that post-acquisition. Next slide, please. Value chain planning usually has 3 phases. The assessment phase of feasibility, which is really what you need to get done pre-acquisition. And normally it takes the shape of sort of a cost-benefit, high-level cost-benefit analysis that sort of look at the various options you have for optimizations, where then you can think about what is the interest rate that ideally you would want to push down, what is the level of management fees, and then look at those options and which are the options that will allow you to achieve that right level of extraction, but also that is going to increase the potential return on the investment. And then the last 2 phases, the design and implementation, really can happen post-implementation. The design phase is more about sort of really doing more due diligence on the option that you think you want to implement, and then of course sort of implementing it by setting up the new business models, the transfer pricing policies, and so on. Next slide, please. Just to give you an example, a typical supply chain is made up by 3 main building blocks: buy, make, and sell. And supply chain planning is really going into each of those blocks and trying to identify some of the inefficiencies. On the buy side, for example, you might have companies that buy from suppliers, all different companies, and therefore you might not be generating the right volume discounts or achieving synergies by really having a centralized procurement company. On the make side, you might have very valuable IP such as patents, and these might be sitting in different entities, and therefore you might have R&D cost leakage because different entities are running their own independent R&D. And on the sales side, again, you might have some very valuable intangibles such as brands that are not centralized, or even on the sell side, you might have lots of entities, they're all selling and they're creating pockets of profits where you really want to centralize those profits to boost the ability of one entity to really pay for the interest rates and the management fees. Next slide, please. This is just really an example of some of the key things that you can centralize. So on the buy side, what you would be looking to move is really the procurement strategy and the risk. On the make side is really centralizing, moving the intellectual property in relation to manufacturing, but also the manufacturing oversight and risk. And on the sell side is really about the brands and the commercial strategy and distribution risk. So overall, next slide, please. Supply chain planning can really help you generate cash benefits. It can really enhance your ability to pay interest and management fees. It also makes it easier to integrate new M&As. And overall, it can lead to a lower tax leakage and also reduce the disallowance on interest rates and fees.
So I suppose, Fabrizio, a few little thoughts from me on those ones as well. I think sort of some really thought-provoking points, and in particular, sort of thinking about how, this within an intragroup context, how the supply chain and the planning that can be undertaken can form an important part of diligence. Noting that you could think about that as part of your strategic considerations for an acquisition strategy, and how actually that can form part of developing a new business plan. And again, sort of simultaneously thinking about the transfer pricing aspects of that, but also, as Fabrizio mentioned, the easier integration of new add-on opportunities and how strategically that might, be incredibly important. So I think, how those pieces interact is really pertinent here. I think the other piece, is around centralization, and how actually within broad group structures and actually within fund structures as well, what could be centralized, what could be shared, and how sort of TP and supply chain planning can form part of those strategic conversations, maybe in a buy and build strategy, or maybe where you have a number of similar portfolio companies within a fund. So yeah, some really interesting stuff there to pick up on, and I'm sure it will be picked up on further in the Q&A. And yeah, with that, I'll pass back to Christos to take us into the next stage.
So thank you, guys. Thanks for the insightful presentations. Let me make a quick analysis for the those discussions, and feel free, guys, to give your comments on them as well. The first question that it is about the decision and selecting your trusted pricing advisor. Here we have a perfect split, this approach and experience, and none of them voted for the price. So this means that the clients want a good quality transfer pricing advisor with good experience and they know how to approach the client. And this means that they want tax certainty and they don't want to make an overlap or something like that. So these are good news. And moving on to them, choosing your favorable interest rate. Again, the clients seems to move to the market rather than moving for a conservative approach. So high as possible, which is the 26%. It means that they are conservative. Whatever the market rate means, this is something like a balance, and another 27%, I will let my trust advisor to guide me. So it seems that the majority, they go to the market to find their answer. Now, let me go to the questions. Let me start with you, Fabrizio. I think the value chain is very exciting and it's very practical, and I like your bird's eye view that you have provided. Let me make a question that we all know that transfer pricing is all about function, asset, and risk. However, post-BEPS, we know that risk is a king. So when it comes to the value chain planning, how you manage your risk and achieve optimal results in practice?
Well, that's a very good question. Obviously, paperwork, sort of empty structures never work, right? Moving function and risks is not about signing a contract that says you move those. It is really about operational change and substance. In transfer pricing, I mean, obviously BEPS kind of spelled out some of the more aggressive tax planning that had been done in the past. But really, transfer pricing was never designed to just shift profits based on a benchmark, right? True arm's length nature is that you're really aligning the transfer pricing and the tax structure to the commercial strategy. So when it comes to supply chain planning, the way to really manage the risk and make sure that the tax authorities can actually, cannot attack you on the planning that you have done is to really show that people are actually doing what the transfer pricing documentation or the agreements say, and that you have the right people in the right jurisdictions. They are driving those key functions and risks. So that's the most important thing to manage the risk.
So it's all about people, Fabrizio, right?
Exactly. It's all about people, and it's about people is probably one of the most difficult things to achieve when you're doing supply chain planning. You really need to spend time with the people in the business. It's not just about talking to the head of tax and the GC about contracts and tax models and all that. It's about talking to the people that are driving the business to make sure that they can buy into that idea, that they feel that idea of centralization and being located in a certain jurisdiction is actually commercial and can work.
Okay, many thanks, Fabrizio, for your insightful comments. Let me move on to Gaspar, and I will stay within the risk area, which is greatly important, and trying to combine it with documentation. So when it comes to transfer pricing risk management, Gaspar, about documenting control over the risk for the different divisions of the investment fund group, what do you see your practical experience on this?
Yes, thank you, Christos. It's very interesting. It's very interesting, the question and the opportunity to share those points, because it goes back to substance, but also to the strategy. So if the fund management group wants to operate in a certain way, or just happens to be operating in a certain way, which has been driven by all kinds of business reasons that play a role, and also as the group changes, because gradually as new trends come along, as other models become successful in different between competitors, groups also tend to consider changes, and there the transfer pricing question or the tax question is, how do you start to document those the functional profile of your entities, and whether your transfer pricing is solid or needs adjustments. And there, I think that the role of reporting lines is significant, because that gives you a framework to start understanding also, if we look at the essence of current guidance on transfer pricing, the decision making, the way the different functions work together and the pieces come together is really essential. So this is particularly true for cases where the group does not have one place where everything happens, but has highly integrated functions happening in various places, various jurisdictions. There, looking at reporting lines may be a very good way to start to document and to also map change. And this is true for the structure of the fund, as well as for the M&A, so for the investments below the fund as well. How different functions in a structure interact together as mapped through the reporting lines is very useful.
Thank you, Gaspar, for your comments. I was tempted to ask you this question, but due to the time, I will move on to Andreas' point this question. Andreas, we all know that companies is a living organization, and everything changes from time to time. And now with the technology, I think restructuring can be done very rigorously. What do you think about updating a transfer pricing study? I mean, how should the transfer pricing risk management be structured in terms of timing for the preparation of the application and any subsequent review in this respect to safeguard clients?
Thanks. Yeah, I think every client, every fund should have a clear strategy and a transfer pricing policy in place to follow. Otherwise, there are certain risk areas which may be difficult to treat with a bit of delay in terms of timing. I mean, generally speaking, it's recommended, of course, to document or prepare the TP documentation at the time a transaction occurs or shortly thereafter. This has two main reasons. First of all, the more time flies by, the more it is difficult to trace back the relevant information afterwards, and the easier it is to overlook something. And at the same time, that's the more risk-oriented issue. If the contracts have already been concluded and you perform and the transaction has been performed, and afterwards you perform your TP study, you may have the issue that the results of the TP study do not match the contractual agreements, or that you lose credibility in trying to justify, for example, results which are a bit more, let's say, ambitious or more desired results, as opposed to results which are really in line with the value chain of a certain fund. So that's why, taking care of your transfer pricing documentation too late may trigger some practical issues, but also some real, tangible tax and transfer pricing issues. That's why typical triggering events should be considered for each fund. For example, the acquisition of a new portfolio company to see how the overall risk profile of a fund changes, which may impact the risk profile, for example, for financing activities. Additional funds, or the amount of funds under management, assets under management, which may have an impact on the management fee allocation. The question whether the operational model has, for example, changed, have employees been shifted. All these structural changes should trigger the reflex to at least review every now and then the transfer pricing policy, and to see whether the transfer pricing documentation is still in good shape. Other examples would be, for example, macroeconomic effects, as we have seen recently with COVID, which also had quite some impact on the pricing of certain goods and services. So on an overall basis, it's a very important aspect and highly recommended to factor in at an early stage. Although we also know that during the acquisition phase, the efforts are more focused on, for example, the deal making perspective, but still it should, if possible, be integrated at the same time to avoid bad surprises afterwards. Also because tax audits, they occur sometimes years afterwards, and that means potential problems pop up with a lot of time delay. And this particularly applies if you have several countries involved, and you potentially need to engage into a mutual agreement procedure in the treaty, which may sometimes even give rise to another practical issue that until you reach an agreement between the states, the lifetime of the investment fund of sometimes only 5 to 7 years is already exceeded. That means you need to keep the fund artificially alive to wait for the outcome of such an MAP procedure. The issue being that as a taxpayer, you don't really have any means to force the process to speed up the level of the tax authorities. That's why an early consideration is important. And as a last point, before I pass on the word again, we would also, based on the recent developments in the tax environment, it is highly recommended also to use the transfer pricing documentation to integrate your explanation of the commercial rationale and the functioning and of the value chain in your transfer pricing documentation. There are a number of legal bases, for example, the principal purpose test in double tax treaties, the main benefit test under DAC 6, or the general anti-abuse rules, which have been introduced in Europe through ATOZ 1, where you need to be able to demonstrate all the non-tax reasons driving a transaction and the functioning of a fund. And this is particularly important not only for the transfer pricing dimension, but also for a lot of other different aspects. So this is more like an opportunity to kind of combine several aspects like the TP and the tax dimension at an early stage to make sure that your tax risks are mitigated over the lifetime of the fund, and that potential risks do not span over a period which is even exceeding the lifetime of the investment fund. So to pass on the message back to Christos, I would say it's always highly recommended to keep your EP documentation in a good shape and rather think about it earlier than later, because then it's easier to fix issues.
Yeah, I mean, being proactive, Andreas, is always better than being reactive. I totally agree with you. Don't want to end up to a mutual agreement procedure with the government because this takes years. I also agree with you that the new anti-avoidance provisions found on the EU and in the OECD model commentary, they smell of transfer pricing substance. So having them both proactively, I think you have more benefits than disadvantages. So let me move now to Deyan. Deyan, I will kind of change a little bit the subject. You have mentioned a lot of practical issues that you see in practice, and you raise various questions about debt pricing. And from your experience, which one of those practical questions clients typically overlook, or even if they spotted they incorrectly applied managers? What is your view on this, Deyan?
So I think on the basis of the transactions and the investments that I follow, we have found that in certain cases, clients, I mean, when it's during the actual deal, so at acquisition, I think it's pretty simple not to overlook things, because the deal needs to be done. You need to get the answer. You need to put the agreements in place, potentially get the documentation, everything in order. So it's sort of complicated to forget about things. The complications start when the initial acquisition has been done, and then particularly if you're on the deal side, you're working you are part of the deals team. You don't necessarily, or that's my own experience. You don't necessarily follow very closely all of the investments. So in some cases, you might find that there are a couple of bolt-on acquisitions to this or that investment in a different country. And by bolt-on investments, we mean investments that would give rise to what I call a credit event. So these would be investments that have sufficient capacity in terms of earnings to change the debt pricing equation, and that will require a restart or reboot of the transfer pricing policies. So out of all these points that I had on my slide, I think the one that gets that is most likely to get overlooked is probably in relation to bolt-on acquisitions or disposals in certain cases. And the other one is there is a second one, the secondary, which is more about the external factors, which we need. When we do transfer pricing, we need to be aware not only of what's happening with the so-called facts and circumstances of the client, but also what are the facts and circumstances of the industry where the client operates. So if there are some external factors which are expected to impact earnings capacity in a very negative way, that will require an update, that will require a rerun of the analyses and potentially some changes to the terms and conditions. So these are the two.
Sorry, go ahead, Deyan.
Yeah, these are the two main points that I have seen. Maybe, yeah, I think probably we should try to do some Q&A now, in the interest of time.
We have, let me make one more questions to Niall, and feel free to make your question and answers. We have another 2-3 minutes, 5 minutes, and then we can answer any questions that you like. So feel free to post your questions, and we are going to answer them in 4 or 5 minutes. So last question is for you, Niall. We want your different perspective. So how have you seen this area practically develop in the last few years from your perspective?
Yeah, I think it's an interesting one, and probably to echo actually quite a bit of what Andreas mentioned previously as well. I think what we've seen is certainly on intragroup financing that's come under increased levels of scrutiny across Europe from tax authorities, and with that that important piece of maintaining, as Deyan mentioned, kind of reassessing, relooking at your documentation in those areas, what files you have to support positions taken, and then with it kind of again echoing a little around what Deyan and Andreas mentioned in their previous sections. Actually, are we implementing those policies and that documentation appropriately, and being sort of robust, consistent, and actually applying, doing what we say we do. So we've seen that coming sort of more and more into focus, and I think that's just sort of I see that as the way that the direction of travel as well going forward, and certainly from the conversations we've had.
Thanks, Niall, for your valuable feedback. So, guys, feel free to pose your questions. We have, I'm looking here, the questions coming in, so feel free to post them. First question is, what does a multilateral IPA procedure look like for fund management companies? And are there any other ways to engage with the authorities in various jurisdictions? So perhaps, Andreas and Gaspar, you can provide your views on this.
Yeah, actually, like an APA procedure in the fund context, that's rather like an extreme case that's to be avoided at all costs, because it triggers like unexpected costs and like an unexpected kind of timeline in a fund context, especially. There are other ways. I mean, the best way is to reduce like the risk of challenge by being prepared and have like proper TP documentation in place. We did have like a few extreme cases where the authorities did not challenge the quality of the TP documentation, but more the overall substance. And that's also one important point that has been mentioned before. It's really important that the overall substance is in line with the legal documentation and the transfer pricing documentation. Because sometimes after things have been implemented, it may occur that the procedures are potentially not like strictly applied anymore, and that potentially decision-making procedures are shifted between different entities in different countries. And that's something which is extremely risky. That's why the best recommendation to deal with that is to make sure that the business model, as has been analyzed in the beginning, is something that is really lived and applied in reality and is in line with all your documentation, and that also subsequent changes and deviations to such models, for example, are properly reflected. Other means are, generally speaking, the discussions during the tax audits, for example, but this is already like a stage where you want to keep the kind of the leeway to a minimum to, in the end, avoid like a lengthy MAP procedure. Gaspar, you also wanted to add something?
Sure. I can say that I could, yeah. So fully agree. APAs are tricky. Sometimes they may be necessary in cases where the situation is so desperately complex that's close to your last resort to try to get some certainty. But I agree, it's complex, and it typically looks like a series of, if we're looking into more than 2 jurisdictions, it typically takes the form of a series of bilateral APAs, and there's a number of important points, such as making sure that all the tax authorities are familiar and comfortable with the text, that the text is the same, and so forth. Aside from that, of course, besides MAP, there are some other routes possible to try to manage relationships with the authorities, such as the ECAP, which is the International Compliance Assurance Program set up by the OECD, and it's sort of a soft way to approach authorities and to try to obtain some sort of confidence in their stance. There's a taxpayer can take also the initiative to do if there is an audit, it can try to involve another authority from another country to have a joint audit and to participate in that somehow, or and most there's a general idea that in the MAP procedure it all happens between tax authorities, but taxpayers can also be proactive in trying to help the authorities to prepare documents or to try to argue positions and make their case, and we've seen that to have been effective. So in a nutshell, it can be complex. There are several mechanisms available. There's also the arbitration convention in Europe. So there's a few possibilities, legal instruments to go through. But most importantly, this is certainly, as Andreas said, an area where careful thought about which route to take and the cost involved and the time consumed in terms of resources and expectations is something that has to be considered very carefully.
Many thanks, guys, for your valuable impact. Agreed that APAs is a proactive measure to solve the problem of transfer pricing judgment, and OECD is very keen on this, so they want proactively to solve the problem. Otherwise, the reactive tool is the binding arbitration. So yeah, if you solve it proactively, you are much better off. So let me make another question. Fabrizio, we have a question here saying that, and if you can kindly answer this, is that I have a benchmark and I want to support the interest rate. Is having a benchmark enough, or you need a full transfer pricing study highlighting the risk and rewards?
Well, so you see, a benchmark is a benchmark. A benchmark doesn't mean that the transaction is arm's length, right? And there are ways that you can come up with a benchmark that could potentially support a higher interest rate. But really, what you really want from your advisors is something that says that what you're doing is arm's length, as opposed to this is the arm's length range of interest rates. So I suppose you don't necessarily need at the very beginning, you don't need the documentation. You want to have that documentation ready, and you want to start, as Andreas said, you really want to start sort of collecting all the information that you need, right? But you do need to look at what is the benchmark telling you, but then what are the financials of your portfolio companies telling you, because that's what drives your ability to either deduct that interest or not. Then, so that's the kind of the first step, and then of course you want to start collecting all the information that you need so that you can tell a story, right? So when you're drafting your transfer pricing documentation, the benchmark is only one element. But really what you want to show is that you've really looked at your business, you've looked at how your business is going to perform, how it's going to evolve, and therefore you think that that benchmark actually is arm's length in relation to your business. And one of the sort of the classic sort of risk that gets triggered is when tax authorities look at the benchmark, they look at the transfer pricing report, they look at intragroup agreements, and then they look at what people are doing, and it's a total disconnect. So you really want to be consistent on everything that you do.
Apologies, I was in mute. Just to make this, Fabrizio, more practical, do you believe that is there any, we'll say, weight on the benchmark? I mean, like a numerical, it's 50-50, the benchmark and the remaining part of the transfer pricing, or is less weight or more weight if we want to make it more practical?
I think more than the benchmark, what's really important in terms of if we're talking about an actual sort of economic analysis, I think what I find, and this doesn't just apply to interest rates, it applies also to management fees, applies to any transaction that you might want to benchmark, is also to be able to run a sensitivity analysis, right? That benchmark is going to be subject to all various critiques by the tax authorities, right? They're going to say, I don't like this comparable, or I like that comparable that you threw out of the set, right? So what is important to do is not just to come up with your final range, but also look at what happens if the tax authorities disagree with your range. Because if you can run sensitivity analysis, it will make it harder for the tax authorities to argue on that. And then, of course, telling the right story and making sure that what you're saying in that report is actually what you're doing.
Okay, Fabrizio, many thanks for your feedback. I have another question, and this is for you, Deyan. The question says, how do we prove documents that management services by the investor are actually rendered for TP purposes to avoid their operating companies? In order to avoid that, it is challenged by the tax authorities in, for example, 3-5 years. Are minutes of meetings and strategy papers required? What is your view on this?
Right. First of all, it's very difficult, or I would almost say it's impossible to avoid the possibility that tax authorities will challenge a particular arrangement. In practice, what happens is you prepare for the worst and you hope for the best. So you can never, no matter how much documentation you'll have, what sort of proofs you'll have, you're never bulletproof that the tax authorities are not going to come back with, I call it some stupid question, which basically will demonstrate that they will not necessarily understand the model or the way things are supposed to work. What I can give as advice in such circumstances is just to make sure that you have a coherent story. So just building up on what Fabrizio said, I think of our job as storytellers. So what we need to do is we need to build the story around what has been happening around the business, whether it's management services, interest rates, or whatever. So what we need to do is we need to have proper demonstration, and we need to have proper documentation. Again, documentation in this sense means the larger thing, not just the TP report, but also we need to be able to demonstrate the intent of the actual arrangement. Most of you guys will have heard of the OECD principle of starting from the actual definition or the contract. This was something that was published, if I remember correctly, in the 2010 OECD guidelines. So you always start with the actual contractual arrangement, but then you need to be able to double up or to demonstrate that what is said in the contract has actually happened or continues on happening now for the periods that are under review by the tax authorities. But again, I mean, you cannot avoid that there will not be some stupid questions from the tax authorities, which may or may not, they may have the answer in the actual documentation, or they may need some additional analysis. But usually, our approach in general, I think, for all of our colleagues, is to try to be very dialogical, to be able to demonstrate to the tax authorities and to explain, start from the start, and explain the whole operating model, how it was put in place. If there are mistakes, by the way, some tax authorities appreciate if you just say, well, we didn't implement correctly, now we're making an adjustment. We want to be very dialogical. So from that perspective, in many jurisdictions, it's good to be able to have that backup. So.
And I think it's also, it's great to keep a good audit trail, right? Because facts are very important. So anything that you can collect to demonstrate that decisions are made where they should be made, that's your proof, right? And sort of the opposite is you really want to avoid a bad audit trail, because that's what happens when the tax authorities come in. The report looks great, everything looks great, the contractual arrangements look great, the people are in the right place, and then they start looking at your emails and they start looking at certain documents, and suddenly they start doubting that actually those people were making the decisions, right? So really keep a good audit trail, but avoid a bad audit trail at all costs.
Right. Coming from an Italian, that is very valuable.
So, guys, for the interest of time, one last question is that what are the specific transfer pricing aspects you will pinpoint for carried interest payable by a Lux fund to carry vehicle located outside Luxembourg, let's say, for example, in Cyprus? Andrea, you want to get this question?
Yeah, very briefly, because we're close to the end. Typically, like, the carried interest structuring is less a transfer pricing issue because it's an agreement between the fund manager and the investor, so it's by definition at arm's length. It's more tax structuring question because there are different options to increase the tax efficiency of the carried interest, for example, by structuring it as a preferred dividend as opposed to a pure management fee. So it depends a bit on the contractual arrangement, but typically, like, it's defined as a waterfall in the limited partnership agreement or the fund documents, and there's a bit of leeway how to structure that. As such, in very few cases, it's a transfer pricing issue, unless you try to kind of cut it into smaller pieces and achieve a different treatment from a tax perspective on those like different kind of elements of the carried interest. But typically, it's more a tax structuring point than a TP issue.
Okay, eventually we are at the end. Many thanks, guys, for your insightful contribution, and thank you all for turning into today's session. We hope you enjoyed all our insights. Please keep an eye on your inbox for invitation to future webinars. A reminder, our speaker profiles, the info will be found in the presentation slides that will be forwarded to you post the event. And if you have any other questions, feel free to send an email to taxand@taxand.com and you will be directed to the appropriate contact. Enjoy the rest of the day, wherever you are, and see you soon to a next Taxand webinar. Thanks, guys. Take care. Bye-bye.
Thank you. Bye.
All right.